I think clearly the dividend policy does play into how we run the business. We are still in cash conservation mode. We are being prudent, bearing in mind that liquidity has only been restored from Angola during the last month of the financial year that we're reporting on. So we are being cautious, knowing where we've come from. We've still got about R1 billion that we have in Zimbabwe, which we are struggling to transfer out of that country, given the well-known economic difficulties that they're experiencing. And we have the sale of our glass business, which we hope to conclude by the first quarter of the next financial year. Once that is done, we will be in a position to return money to shareholders, and we have signaled to the market that we think that it's probably better for us to look at a share buyback given current depressed share prices. We think that there's a lot of value in it for us to pursue a buyback program rather than going for a once-off special dividend, which will cause a once-off spike in the share price, and then after that you will just resume to the normal pattern. So we think that's a great way of returning cash to shareholders, and then subsequent to that we will return to a normal, consistent dividend payout program.
And can you take us into your confidence regarding negotiations for the sale of your glass business? I mean, it's not the easiest time to get fair value for a business in this economic climate. Are you anticipating to at least get the right value for this, or could it possibly be a fire sale?
We have received indicative offers from a number of interested parties. We're in the process of completing our due diligence process, and we will have final offers on the table probably by the end of this month, if all goes well. And
local or foreign offers?
It's a combination. Okay. So all of the players have a BE component, which one would expect, and then there is also an international component bringing the skills to bear that are required to run this asset. And that's really the reason why we've engaged on the sales process. Everything is on track. We anticipate that net asset value is probably in the realm of the realistic. But let's see what the final offers say when they come in.
All right. And then if we just focus on your rest of Africa operations, starting in Zimbabwe, where you say you've got quite a bit of cash trapped there. I mean, the president has continually repeated the message to foreign investors such as yourself that Zimbabwe is now open for business and has taken quite a number of steps to improve the business environment. What is your experience on the business climate there, other than the currency headache?
We've actually had a great year in Zimbabwe. We've been able to grow market share. We've been able to expand margins. We are using Zimbabwe as a base from which to export, which of course is very important in order to procure foreign currency, which we can then use to buy raw materials, which keeps our business going. We've taken a firm decision as Nampak not to extend further credit terms to our Zimbabwean operations, so our own exposure from a Nampak Limited perspective to Zimbabwe is not increasing. However, because these businesses are so profitable, the amount of cash that we have in that country keeps on expanding. Overall business conditions continue to be favorable. We have had a very strong tobacco crop, and as we manufacture tobacco cases, and that's a great way of earning foreign exchange for Zimbabwe, we get some preferential treatment in the allocation of foreign currency for the purchase of raw materials. So all in all, it's actually been a very good year for us in Zimbabwe, leaving aside the fact that currency liquidity is still an issue.
And I know you're quite upbeat about your Nigerian operations as well, but before I get to that, I also want to talk about Angola, where again we had a new political dispensation. Some of the economic reforms included saw the kwanza being devaluated significantly. Your hedging strategy shielded you from that some part, but again, outlook for Angola, and will you be putting any more money in that country?
We're very encouraged by the steps that President Lorenzo and his administration have taken to restore credibility to governance in that country. He's been very decisive, he's been very bold, and he has also now restored liquidity. So we've been able to extract significant hard currency out of Angola, back to South Africa and back to our offshore treasury operations, And that has restored our confidence in that country and has also enabled us to again resume purchasing raw materials, which will enable us to ramp up volumes in that country. So the market still remains strong. It still remains an attractive market for us, and we are in fact going to invest about $20 million into converting an old tin plate line into a new high-speed aluminium line, and we think that there's an untapped volume of about 300 million cans that we'll be able to sell that we currently cannot manufacture.
Andre, how worried are you about what this oil price is doing now? Because Angola and Nigeria, two economies that are quite dependent on it. I mean, 2-3 weeks ago, people were smiling a lot more about oil than they are doing so now. So your outlook for Nigeria, whereby you've got this country that is certainly not too pleased at this current level of oil prices and the talk of further production cuts, as well as the fact that we've got an election around 3 months away around the corner there, and things are quite politically unstable.
That's not something that we've picked up in our markets. We're quite comfortable with the performance of our Nigerian operations. We're keeping very close watch on the oil price and what that could mean. But bear in mind that the currencies in both Angola and Nigeria have devalued significantly. Previously, the lower oil price coupled with a peg to the dollar caused severe liquidity restrictions. But now that the currencies have been devalued to a normalized level, we anticipate that the impact of a lower oil price will be significantly less than during the previous period of low oil prices.
All right. So it's not every day that you hear of a South African company that is doing well in the UK. You happen to be one of them. Again, I mean, the UK quite a lot of risks, especially as, you know, we look at this Brexit deal and whether Parliament will approve, whether Parliament won't approve. But what does this mean for your business going forward?
I won't say that we're doing well in the UK. We're doing better than we used to do. It's still a tough market. Milk consumption is way down, and obviously because we manufacture packaging for the dairy industry, that has had an impact on our volumes. Brexit is something that has injected considerable volatility into our markets. We operate a plant in the Republic of Ireland, and we operate a plant in Northern Ireland. And we regularly transfer packaging between those two plants. So we are keeping a very close eye on what the Brexit situation will mean for us. And it's very interesting to watch the political turmoil that has been caused by this referendum, for which we don't think that there was a plan B. So it's been fascinating to watch. But unfortunately, we are having to manage through a period of significant uncertainty as to what exactly will happen. And I think that makes us one of many businesses in the UK.
And Andre, just a final question, if we bring it back, I mean, home. Manufacturing sector in South Africa is still in a difficult spot as the economy grapples recession and the like. What can we expect from Nampak's South African operations, which weathered pretty well considering the tough environment? And I mean, we've got this Tumamina campaign by the president where he's calling on South African companies to inject further investments in South Africa. Where does Nampak lie on that regard?
I think what the South African economy requires is a catalyst to unlock demand. We have seen consumer purchasing power come under significant pressure as a consequence of the sugar tax, higher fuel prices, a VAT increase, and in the absence of a catalyst to put more money into the pockets of consumers whereby they can buy FMCG products and then stimulate demand, we will continue to have to be very careful about how we invest, where we invest, and how we operate in terms of our cost base as well.